What's a typical loan term for a shopping center? Leverage is the amount of loan you have compared to the total cost. So we typically in a mall like to have 50% leverage. So if the enclosed mall is a $20 million acquisition, we'll put 50% debt and 50% equity. On a power center, the leverage might be a little higher. It might be 55% or 60%. So on a $20 million power center or a neighborhood center, the loan might be $12 million instead of $10 million. So the loan typically will have an amortization, and the amortization will be 20, 25, or 30 years. Our goal is to try to get an interest rate somewhere between 7 and 8%, and we like to use community bank or regional bank loans. The two other places where we can get loans are through what is called commercial mortgage-backed securities, CMBS, and these are pools of $1 billion of loans that are put together, and as a result, it's pretty rigid, but you can get a little bit more leverage, and your interest rate might be a little bit lower. The third source of loans are insurance companies. Insurance companies often have non-recourse loans. Their interest rate is between CMBS and a bank loan, but there's a lot of inflexibility in terms of prepayment with an insurance company loan. Typically the loans are fixed for 5 years. There could be a year or two at the beginning of interest only, and then we'll start an amortization. Sometimes there is a prepayment penalty, so if you want to prepay the loan for a regional bank or a community bank, typically there's a 3-2-1, 3% prepayment penalty for the first year of the loan, 2% second year, 1% the third year. For a CMBS loan, typically it's very expensive to prepay a CMBS loan. Typically those loan terms are 10 years, and if you want to pay it earlier, you have to do what is called defeasance, and that means you have to pay some kind of calculated penalty that would impute the amount of interest the bondholder would have received for the last 3 years or 5 years of that term. And the same thing is required if you prepay an insurance company loan. A community bank loan or a regional bank loan is that oftentimes, if you need more funds, particularly for new tenants, you can do what is called good news lending. You can execute a lease, get a lease executed with a quality tenant, investment grade tenant, and take that lease to your lender and say, hey, this TJ Maxx needs another $1 million of tenant improvement dollars. Can we go ahead and borrow that from the bank? And the advantage of that is that you don't have to go back to your investors and fund more equity for TJ Maxx. The bank can do it. The advantage of the bank doing it is by having a TJ Maxx in your shopping center, the cash flows will be stronger and the underlying credit quality will be higher.